and good afternoon, ladies and gentlemen. It's 5:30, so perhaps good evening, definitely cocktail hour. Thank you so much for joining us today for this panel on the OECD's Global Minimum Corporation Tax and the challenges it poses for the UK, kindly hosted by the Institute of Economic Affairs. My name is Kate Andrews. I'm the economics editor at The Spectator and former associate director at the IEA, and I will be your chair for today's discussion. Now, before we turn to our panelists, I've been asked to address some very quick housekeeping points. The first is that the event is currently being live streamed onto the IEA's YouTube channel, and it will remain on the channel for later viewing. So I think this is the polite way of saying to our audience in person that Big Brother is watching. As well, if you need the ladies' lavatories, they can be found by leaving the Selden room, going down the stairs. They're on your left. For the gents, you leave the Selden room, go through the garden, and they're on your right. In terms of the running order, I'll be giving each panelist 5 minutes to give their remarks before I, as chair, abuse my position and ask a few questions, and then I will turn it over to you, the audience, and field your questions. Sadly, we can't take any questions from people live streaming, so the pressure is on our in-person audience to ask some really good stuff. So I think we can pretty much dive into the debate. Corporation tax reform is thought by many to be long overdue, and arguably a new structure for taxing big corporations agreed by advanced economies is a step in the right direction. This historic deal would see a major shift in the way companies are taxed, away from the existing model in which they're taxed in accordance with where their product is being created to a new system based on where they're operating. And this may better reflect where taxable activity is really taking place. But at what cost have we signed up to this deal? The United States' willingness to compromise in some areas is based on a new structure, a new agreement to implement a global minimum tax rate of 15% for corporation tax. So somehow we found ourselves in a position where the world's richest countries are in the process of undercutting economic principles, mainly competition and the ability to track business, that have been responsible for increasing people's prosperity across the globe. Now, it's easy to see politically why they're doing it. In the short term, they may gain by forcing countries to hike their corporation tax. But what about those crucial economic principles? What about fairness? And what about the long-term economic consequences that could come from stifling competition and actually make it harder for everybody, including those countries at the top? So to dive into this, we have an A-list panel that's been assembled here tonight. On my right, we've got Richard Teather. Richard is the leading British academic specializing in taxation, particularly offshore finance centers. As well as his academic work, he acts as a tax policy consultant, and he's the author of the IEA publication, The Benefits of Tax Competition. We have Lord Kamall. Lord Kamall is the Conservative member for the House of Lords and also Professor of Politics and International Relations at St. Mary's University, Twickenham, and is currently an academic and research consultant for the IEA, having previously worked as the academic and research director of the IEA. And I think when we first met, many, many years ago, you were a Conservative MEP from 2004 to 2019.
Sorry about that.
It worked out okay. On my right, I have Stephen Catlin, who's the chairman and CEO of Convex Insurance. Stephen has over 45 years of experience in the insurance industry. He was the founder and CEO of the Catlin Group, a major international insurance and reinsurance company operating worldwide, and he now serves as the chairman and CEO of Convex Insurance. And also we have Mark Littlewood, the Director General of the Institute of Economic Affairs and the Ralph Harris Fellow. He's held this position since 2009 and was formerly the Chief Press Spokesperson for the Liberal Democrats. And
I'm sorry about that.
Yeah. You can weigh up Saeed and Mark's accomplishments in those two particular roles over drinks at the end. Mark was also an advisor to the Conservative Party under Prime Minister David Cameron, so make of that what you will as well. So we're going to jump into 5 minutes of remarks each. Richard, we'll start with you.
Thank you, Kate. The OECD's global minimum tax is basically a backdoor attempt to impose, as it says, a global minimum tax on the rest of the world. Countries will theoretically be free to have lower tax rates, but if they do, then any other country that's connected either by having part of the same multinational there or part of the same global supply chain, will be able to tax the profits of that lower tax company as a top-up. So if Ireland still has 12.5% tax, for example, and an Irish company is part of a global group with a British company, then theoretically the UK will be allowed to charge an extra 2.5% tax to top up that Irish tax to 15%. The practicalities of that are going to be horrendous, partly because every country has different ways of calculating tax. So you could have one country that imposes a 15% tax, but another country calculates profits in a different way, says that the actual taxable profit should be higher, therefore your effective tax rate is less than 15% and still ends up charging a top-up. And once you've got 3 or 4 countries doing that with your multinational, I sort of regret not still working as a tax lawyer, because it's going to be a very lucrative profession for the next few years. But this is a complete reversal of the international tax system that we've had for 100 years. And yes, as Kate said, the old system wasn't ideal, but it tried to tax people where they were based and businesses where they were based. This is now just basically allowing a free-for-all and allowing any country that can have some sort of connection with a low-taxed company to be able to tax that. It's an attempt by politicians to tax foreigners on income earned abroad, which is lovely for politicians because they think it doesn't affect their electorate, but it's going to be disastrous for international business. Okay. This is presented as being about fairness. Yeah, it's about trying to spread the tax burden more equitably, but actually what it's really about is collecting more tax from business. Since the OECD started these moves in about 2004, we've seen increasing signs of taxes on businesses going up, either corporate tax rates themselves being increased, or more commonly fiddling around with the definition of taxable profits, disallowing expenses, reducing allowances, things like that, so that for any given level of real profits, your taxable profits are increased, and therefore your effective tax rate's increased. And that's what we've been seeing increasing amounts of over recent years. Governments tend to see this as a free ride. Yeah, they think that by taxing companies don't vote, so therefore they're getting some extra revenue without facing any backlash from the electorate. And politicians, yes, there's always spending pressures. Politicians are always looking to increase taxes. But what used to happen is that the ability to move to a lower tax jurisdiction effectively acted as a pressure valve, as an early warning signal to warn governments that they were going too far and to allow them to reduce the taxes. Now we're getting rid of those pressure valves. There's nothing to stop governments increasing taxes until we get back to the 1970s and economic collapse again. And they're seeing taxing companies as a free ride, but actually, when you tax a company isn't a real person. So when you collect taxes from a company, somewhere, some real person has got to suffer that loss. Yeah? Either it's the shareholders because the profits are lower, or it's the customers because in order to cover the loss of revenue, they're pushing up the prices, or it's the suppliers being squeezed, which just passes the same problem on to them, or it's the workforce. And one of the big problems is, one of the things that we know about tax is that one of the groups that really suffers when you raise taxes on companies is the workforce. Oxford University did a big study a few years ago where they found that for every £100 extra tax that you collect from companies, £75 or thereabouts of that comes out of the profits of the workforce, either through lowered wages, rarely, or not getting future wage rises, or layoffs, but most commonly through new jobs not being created because businesses aren't expanding, new businesses aren't being created. So those new jobs that we rely on to generate the growth in the economy just aren't happening. A lot of is presented as being an attack on tax havens and tax dodging. A lot of tax haven activity isn't about avoiding evading taxes. It's about trying to deal with the complexities of the international tax system. If you've got an international investment fund and you're getting investors from a whole range of countries, you're pooling their money together, and then you're investing in active businesses in a whole range of countries. I worked in this. Trying to do the tax on that is horrendous, and you risk having triple taxation where the underlying businesses are taxed where they're based, the funds taxed where it's based, the investors are taxed where they're based. And trying to deal with that is very expensive, great for tax lawyers, but not really any good for anyone else. So what we commonly do is park the investment fund into a tax-free jurisdiction, so at least there isn't any extra tax levied there. Yes, the investors are still taxed where they're based, the underlying businesses are still taxed where they're based, but we don't get that extra layer of tax just because we're collecting those funds together, pooling them. And the same thing happens in the pharmaceutical industry, the same thing happens in reinsurance, anything where you're having to pool capital, pool risk in order to get international capital together causes the same problems. And by trying to impose minimum taxes on these offshore centres, you're putting that at risk. You're putting at risk the ability to pool that capital, to collect funds internationally, to invest into new businesses. And the businesses that really suffer are the ones that we really want. The innovative, high-risk businesses are the ones where you need those profits to make it worthwhile investing. And by taxing them more highly, by taxing that global investment fund or that reinsurance business, you lose those. And what do you lose? You lose high-tech businesses, you lose low-carbon businesses, you lose pharmaceutical development, you lose reinsurance businesses because you can't pool international insurance contracts to set off premiums from one policy against payouts on another one. You lose all of that. And at the end of the day, what we lose is, well, we lose a lot of ideas that aren't brought into fruition, and we lose the benefits from those. As consumers, we don't get those products, we don't get those choices, we don't get those innovative financial services, and as workers, we don't get those job opportunities that would have been created by those. So it's not a free ride. We're walking into this without, I think, anything like enough discussion, enough debate about what's going on, and we really need to take account of this, think about what the unintended consequences are before we get stuck into an international tax system that will be disastrous for global finance, disastrous for innovation, and will be almost impossible to change.
Thank you so much, Richard. Saeed.
Thank you. I should start off by saying that as a classical liberal here at the IA, I clearly believe in competition generally. I think Mark and I are now competing for the most unpopular previous career. But also tax competition is a good thing. And when you're considering corporation tax, particularly in terms of attracting investment, companies don't just consider tax, they consider that as one of the factors that encourage them to invest in a particular country and to engage in FDI, inward FDI. My early academic career was in the academic area of international business, and we looked at the factors that attracted multinational businesses, whether they internationalise or how you attract inward investment. And so they'll consider a number of factors. They'll consider the ease of business, they'll consider the stability of the environment, they'll consider the rule of law, they'll consider the legal system, they'll consider the education skills levels of the workforce. So what removing tax competition does, it removes one of the factors that countries can use to attract companies to their local market, or the other way it reduces one of the factors for companies to internationalise and go elsewhere. Now, I would say I'd give a few caveats as someone who was a politician and thought he'd retired and is now a politician again. Frank Luntz, the US pollster, was here a few weeks ago in the UK, and he said one of the things you've got to start talking about is fairness, whether that's real fairness or perceived fairness. And one of the things when I was previously a politician, I would say to people, lobbyists and other companies that came to see me, is that I would prefer to have no regulation or less regulation. But when something goes wrong, we have to be seen to be doing something, whether we like it or not. And in the absence of that, and that's what often why you'll find even libertarian-oriented politicians making a case, or not making a case, but not be, getting involved in a debate over regulation, let's put it that way. They'd rather not do it, but we have to be seen to be doing something. So it's a bit of CYA, if you like. So one of the perceptions, whether it's real or perceived, is it fair that companies, often with many employees, sometimes pay less tax, either as a percentage or a total, than a small company? Small companies would say, it's not fair. You know, these big multinationals, they come over here, don't take our jobs, so they come over here, create jobs, how dare they? And then they pay less tax. Also, we are familiar with the idea of transfer pricing. There is an issue of transfer pricing, and OECD and others have tried to combat that. Very simply, in simple terms, when companies have internal transactions, rather than charging the market price, they can charge either a higher price or a lower price than the market price, and thereby reducing profits or increasing profits elsewhere, so they can pay lower taxes and high tax regimes. I think I made that far more complicated than it actually is. Now, there are OECD guidelines on transfer pricing, but one of the problems was what happens if you then have a subsidiary elsewhere outside the OECD. It's interesting that the G20 have signed off this agreement, and it's also interesting that Biden's, as Richard said, Biden's administration's proposal to raise taxes for companies based in countries that don't join. I'm really interested in how that will work in practice, and as you say, maybe you should go back to tax law afterwards, and then you can give lots of money to the IEA to say why it's all wrong. But also, Julian Jessup has pointed out that 15% is arbitrary. If the global minimum tax rate is too high, it undermines healthy tax competition. If it's too low, it doesn't really have a significant impact anyway. And what do you do to those countries such as Ireland, Chile and Hungary who have lower corporate rates of tax? So it's one of the things I think we have to ask. But what do you do as an alternative? Should companies be taxed when they're already, some people say, should we have corporation tax? Companies already pay lots of other taxes. They pay employer taxes, they pay employers' national insurance, they pay business rates. Some call for no corporate tax, others call for a few alternatives. Some people say you should tax on employees per country. But that then becomes effectively a tax on employment or a tax on jobs. And what about in the digital world? Where is the value created? Sometimes the value may be created elsewhere and transferred. How do you measure that in the real world? Now, Philip Booth, I'm just trying to name all my IEA colleagues here. I am your ultimate second-hand dealer in ideas. Philip Booth proposes that corporation tax be replaced with a single income tax on capital income administered at the corporate level, similar to how a PAYE works on wages. He thinks that would improve the neutrality between capital income and labour and eliminate the debt capital bias and spur productivity. He's also had a number of other ideas. We like to have a healthy debate in the IEA. Philip likes to have healthy debates with himself. So Philip's also proposed that we tax multinational owners, so shareholders, on the dividends they receive and the profits that are retained in their name. So he feels that would align the systems for taxing equity and debt finance. Now, corporation tax may have well made sense when companies were listed and filed their accounts and were owned all in the same country. But as international capital mobility has increased, as Richard says, it becomes incredibly complicated. And so it's a really difficult challenge for us classical liberals. I mean, maybe it's consistent to say no corporation tax, but then we need evidence to show that having no corporation tax leads to higher revenue or more activity in the economy. And what you need for this is empirical evidence. Now, if we could show that, that would be great. Otherwise, we may have to look at one of the other alternatives. Now, I'm not speaking as a government spokesman. This is just someone. Please don't take this as conservative policy. Maybe it might be a good idea if it was conservative policy. So what we have to do here is really look at corporate tax in the round. Look at how you encourage economic activity and inward investment, and maybe the case for corporation tax on its own may diminish. Thank you.
Thank you, Saeed. Stephen.
Thank you so much. I need to declare a couple of interests here, otherwise you might go away and find out about me and think, well, he never told me that.
You didn't used to work for the Liberal Democrats?
I did not, I'm afraid.
Were you an MEP?
No, I was obviously a complete failure. Catlin Group Limited was a public company at the end. It had a holding company in Bermuda. Its largest trading entity was in the UK, but it did have a trading entity in Bermuda. Convex It's a private company. I won't tell you which I prefer. Which also has a holding company in Bermuda. Its largest legal entity is the UK, again, and a smaller one in Bermuda. As a consequence, I've had to look at this whole issue from an insurance perspective, and unlike my learned colleagues, I'm not a tax expert, in both jurisdictions, which have similar issues but not quite the same. There is one difference, actually, in terms of government interest in the Premier and the Finance Minister of Bermuda I'm in regular conversation with on this issue, and they're right up to speed. They know the issues as well as many do. Unfortunately, in the UK, probably the insurance industry's fault, we're not in great favour with the Treasury or government at the moment, partly because of what happened and things that were said, which were unfortunate, I would admit, over COVID-19. And therefore, sadly, we don't have the relationship here that we should have. Now, having said all that, ABIA, which is the trade association over in Bermuda, I chaired for a couple of years, up until about 6 years ago, and we've been looking at this OECD problem for years. And then I stepped down, I took 2 years out of the industry, so I didn't re-engage on this subject matter until 4 years later. And I couldn't believe it. It had hardly moved one iota in those 4 years. What has happened is, since the Biden administration got involved, things have changed. I mean, Europe has been driving this train for a long time. And by the way, the Bermuda market and the London market are symbiotic. Not many people know this, but something like 40% of the capital of Lloyd's of London comes from Bermuda. So there is an interdependency there between the two marketplaces. I'm actually a skeptic as to whether this will ever happen. I'm not saying it won't or can't, but I wonder if it will. Just when you think about the complexity of 54 states of America, 27 countries in Europe, UK is now on its own. It's a bit like an offshore jurisdiction when it comes to these arguments in some ways. The idea that you can get 27 European countries to agree on this, I find bizarre. They don't agree on many things. And by the way, the corporation tax is different. I completely agree with what Richard said, most of what he said actually. The definition of profit in different tax jurisdictions is huge, really big. So the real tax that is paid in countries has got very little to do with the headline tax. So we're not going to achieve any form of fairness through this. And if you think about getting the Europeans to agree, then you've got to speak to India and China and elsewhere. I mean, these are high hurdles. So it may happen, it may not. I also think there's a difference between the insurance industry, and you say, well, you would say that, wouldn't you, Stephen? But the insurance industry, when it transfers premium, it transfers risk. And the profit is earned to the jurisdiction you transferred it to, earns its profit from the risks that it has taken. And to me, that is a significant difference to, say, a Microsoft, where risk is not transferred, and it is a means of saving truckloads of tax. And I have sympathy with government saying these large IT conglomerates really are not playing the game, they're not playing fair. And if they just concentrate on that, governments will get a lot more money back than they're ever going to get back from the insurance industry. I think the next issue is, okay, so let's say we do agree this. Now, how do you enforce it? How do you police it? Are you going to leave that to individual governments? Do you think each individual government is going to play fair? Be first. And then there's, I think, again, Richard talked about this, there is likely to be unintended consequences. And if this is forced through by the end of the year, which I don't think is likely, but if it was, I can guarantee to you there will be unintended consequences. And that will affect most countries around the world. If we're going to go down this road, and I think it is an if, we've got to understand how extremely complex it is. I said before, I'm not a tax expert. I'm one of those dangerous people that knows a little. But I know enough to know how complex this is. And it is really, really complex. And some of the issues of complexity haven't even been spoken about now. And as you said, I think, OECD is looking at this since 2004. So how do we think we can get, having not talked about some of the core issues now, and get all things done by the end of the year? I just can't buy it. One thing I think we can be certain of, though, is if something happens, there's really only one person going to pay, ultimately, and that's be the consumer. And those of you that are MPs or talking to MPs, it could well be a consideration in terms of getting votes, because what is the benefit of increasing more tax to the consumer indirectly? Why wouldn't you do that up front?
1 minute warning.
Sorry?
That's okay.
I was just about to finish it. This is just our end. I think this is a real and meaningful challenge for the UK government, not just the insurance industry or the oil industry or any other industry. And I hope that this type of debate we're having today will encourage people to speak to ministers to help focus them and understand just what the challenge is. Thank you.
Thank you so much, Stephen. And Mark.
Okay, thank you. Well, I mean, as Saeed has set the tone of we all need to apologise for things, I guess I should start by apologising that I am not Brendan Clark-Smith, the Conservative MP for Bassett Law, who was initially going to be on this panel. I'm not an MP. I wouldn't consider myself a Conservative, and I don't think I've ever been to Bassett Law. And neither am I a tax expert, but I want to point out a few trends that I see in this about the public debate, not the technical detail this others on the panel, particularly Richard, will be better at, but the way the flow of the public debate is going, and for those of us who are concerned about that trend, what we need to do to bend it back. So on the 31st of May of this year, there was an absolutely brilliant article in The Times about this. Full disclosure, it was written by me. The headline was that Britain is right to oppose a global minimum level of corporation tax. The only words in the article that I don't select is the headline. I'm not sure Britain is really opposing it. But I tried to look at it through the lens of, if we saw private sector companies behaving in this sort of fashion, what would we make of it? And we would call it a price-fixing cartel. No two ways about it. Adam Smith would have said this is when people of the same trade are gathered together, a conspiracy against the consumer is bound to result. And in my view, that's very much what happened in the G7 summit in Cornwall. This was price fixing and a cartel, and I think we need to move the debate in that direction. Another worrying term, which I think we need to expunge from the public lexicon in this debate about taxation, is that any reduction in taxation is apparently a race to the bottom. Right-thinking people apparently want high taxes is the sort of thing that we should aspire to. Again, apply the same sort of thinking to the private sector. I see there's a sale on at Homebase. I really hope John Lewis don't follow suit. That would be a disastrous race to the bottom if that happened. Cornflakes are cheaper at Sainsbury's and Tesco's. Boo hiss to that. Imagine how great cornflakes would be if they only cost £25 a packet rather than about £2 a packet. So I think we need to call out that a lot of this behaviour would be completely intolerable if the private sector was colluding in this fashion. Now, I was on the panel. One of the benefits of going last is you can collect your thoughts for longer, but obviously much has already been said. Both Stephen and Richard touched on this, I think Saeed as well. It's not explicitly stated by politicians in the public debate who favour the move in this sort of direction to a global minimum, but it's pretty strongly implied. And the implication is we have a choice. We can either tax corporations or we we can tax human beings. And somehow or other we're going to come up with taxes which, at least on the face of it, give the indication we're not actually taxing people, we're taxing corporations. Of course, you can only tax people in one way or another. I'm not expert enough to know about how the incidence of this tax would fall. Stephen, you said mainly on the consumers, quite possibly, I guess, in some sectors, but Richard, you also pointed out, could be lower shareholder dividends. Anyone who's got a pension that's invested in anything, therefore has a stake in this game, or the workers, perhaps. But it is portrayed as if increasing sort of corporation tax on Microsoft is a straight and direct transfer from Bill Gates's wallet, and Bill Gates's wallet alone, into the coffers of the Treasury for public good. And I think we need to correct that in the debate. That will require some empirical research, but you can only tax people one way or another. You can call it a corporation tax or a company tax or a business rate, but you're taxing people. I've never heard somebody saying, no, we're not taxing farmers, we're just taxing cows and sheep. And it's exactly the same thing here. My third observation is about corporation tax itself, and to pick up your challenge, Saeed, I do favour its abolition. I mean, I'm generally against taxes, but I'm not a complete nihilist. But I think corporation tax is peculiarly bad and getting worse because it is an essentially contestable tax. And whatever you think the tax rate should be, the tax system being straightforward and non-contestable, I consider to be a virtue of it. I mean, I can't deny what the house that I live in, so if you want to charge me on that property, it's pretty straightforward and direct. But in a more globalised economy, as others have pointed out, trying to work out where the profits or the activity has actually taken place and to what rate of return, I think is nearly impossible. One of my favourite hobbies, and I'm not pronouncing in favour of free markets, is to watch Marvel movies. And you sort of, at the face of it, I go to the cinema on Fulham Broadway and I pay 20 quid for a ticket and all the activity is taking place there. But start unravelling the IP and who has rights in the film. How much of that ticket should be rendered back to Hollywood? How much of it is already in agreement with an actor who may not be in the American jurisdiction for tax or the UK jurisdiction, or special effects companies based in China or whatever? Nearly impossible to actually scientifically and logically unravel where the activity has taken place. I think I'm right in saying, this is by memory, so correct me if I'm wrong, Starbucks, with the sort of, was it Starbucks, with the great scandal that they weren't paying sufficient corporation tax, but their argument was, went along the lines of, well, I mean, it is true that we sell coffee in the UK, that is definitely true, but really the reason people come here is because of the wonderful architectural design. The coffee is a bit of a sideline, to be honest, and the wonderful architectural design of our Starbucks outlets is an intellectual property that's registered in the Netherlands, and that's where the principal rate of return is. Now, I don't know to what extent they were trying it on, but it's not a wholly unreasonable argument. Therefore, what you tend to get is a deal brokered between HMRC and the company involved. Not a mathematical equation that you can do on a tax calculator, but a sort of gentleman's agreement. All right, well, you're claiming it's 80% an architectural experience and not a coffee experience. How about we call it 50-50? Shake hands on that. Starbucks agree the check to write. That is, in my view, a disastrous way of collecting tax and catastrophic for tax morale. If you want a fair tax system, that's not the way to get there. The UK, I thought, was moving for a while in the right direction of corporation tax coming down 1% a year. You could actually see a long-term plan potentially to abolish corporation tax. That it wasn't the stated aim, but it was the trajectory. That has gone into reverse. So I'm not optimistic for the UK or the world. I rather agree with Stephen. I don't see this as imminent, but the trajectory of this debate in public discourse is extremely worrying, and I hope I've given you a few thoughts about how we might correct the trajectory and turn around this tanker. Thank you very much.
Thanks so much, Mark. And I believe as you saw the tax rate go down, you saw the tax revenue go up on the same graph, something that doesn't seem to have been taken into account with this planned proposed minimum. Please be thinking of your questions, because I'm going to come to the audience in just a second, but I'll I'll abuse my position. I have two questions. I'll pose them both, and our panel can choose which one they want to answer. And Richard, I'll start with you and make our way down. My first question was to Stephen's point about how this might come in and how easily it might come in. I mean, it strikes me as being extremely fragile. You have the United States, which is pushing this and really wouldn't have gotten over the line without it. And yet, if you look at America's corporation tax over the last three presidents, Barack Obama, Donald Trump, and Joe Biden, you go from a 35% tax rate down to a 21% tax rate, with now plans to go to something like a 26 or 28% tax rate. I mean, it strikes me that the country that is pushing this with a new president in a few years' time might completely undermine it and decide that they want to go in a different direction. So how fragile is this is my first question. And my second question is, really, what does happen if countries don't comply? I mean, are we talking about sort of nudging, polite shoving, or are we going to implement sanctions on Ireland? That strikes me as so out of the realms of possibility, and yet, if you listen to what was being said at the G7 and the G20, I don't know how else they would go about forcing this. So my question is to fragility and also to compliance. So Richard, whichever you'd like to answer.
Thank you. They've been dangerously clever on the compliance thing, because what they're doing is they're not going to force Ireland to put tax rates up to 15% directly. But what's going to happen is if Ireland stays at 12.5%, then you've got some profits of the Irish company that's supposedly had 2.5% too little tax. And basically, I'm grossly oversimplifying, but basically, any other country where that multinational group has a company will be able to tax the company in their jurisdiction on the supposedly undertaxed profits of the Irish company, which is quite devilishly clever because it gets around that whole problem of how do you actually enforce this. I'd love to share Stephen's confidence that this won't happen. I thought that the previous OECD harmful tax practices thing would never happen because they'd never get sufficient agreement. I thought that the EU would never be able to get all the member states to agree on their anti-tax haven initiative. So I've sort of lost confidence in thinking that these things won't happen. I think there's a danger it will. Biden's very much into it. The Treasury officials in the US are very much into it. And what's really been the game changer is that the Americans have, this is known in OECD terms as Pillar 2. There's another part of it, Pillar 1, which is basically the Americans saying, if you accept this global minimum tax, Europe will allow you to have the Google tax, the tax on online companies. And that's what's really suddenly switched the whole thing, because previously you had Europe demanding the online company tax and the US demanding the global minimum tax. And so by putting the two together as a package, unfortunately, it's made it a lot more likely to happen.
It's almost as if when you get these big companies together, they agree to tax themselves more. It's yeah, governments too. Saeed.
Yeah, I think I agree with Richard's answer about the trade-off, and that's been very clever, the way you trade these things off, and that is standard politics. I mean, years in the European Parliament, we quite often get, in order to build a coalition, you would trade off something that very important with someone else for something very important and give up other things. And I think this is a standard sort of horse trading between jurisdictions. I was surprised it happened, like you. But it was interesting because originally what Biden administration said is that they were going to raise, if countries do not comply, they would raise taxes for companies based in countries that don't join. Now, what does that mean? Does that mean that all Irish companies that have a US subsidiary will have their taxes raised? I'm still trying to work it out. Would it be extraterritorial taxation in the same way that, if you're a US citizen, it doesn't matter where you are in the world, you will, you have to pay American taxation. And I just think it makes it incredibly complicated, but I agree with Richard, it has been very clever getting that trade-off. At one time, it looked like the UK was holding out. The reason the UK was holding out was over digital taxation. So they've got that trade-off sorted out.
Thanks, Saeed. Stephen, what are your thoughts on fragility and compliance?
First of all, just to say quickly, I think Richard may well be right, and maybe I'm just wishful thinking. So I take what Richard said.
I hope I'm wrong.
I think it is quite fragile because of its complexity. And I don't know many people that really understand what this is all about in detail. I know one or two, but they live this stuff 24 hours a day. Well, good for them, and I'm glad somebody does it, but most of us don't really understand, actually. And because of my fear of unintended consequences, and that could be global, actually, and because of the potential tension it creates between individual countries, this could be a very dangerous outcome if Richard is right. But I do take, this has been kick-started by Biden and his merry men, and he's been very aggressive on it. He's another one that doesn't understand that, in fact, in terms of insurance, a lot of US business is reinsured into Bermuda. Bermuda paid for something like 62% of Katrina, of the total loss. We'll see what happens with Ida. So it's not like Bermuda's sitting there doing nothing. And if he does force tax onto Bermuda, where there is no corporation tax at all at the moment, there will be consequences of that, and it will affect the consumer. So I honestly don't know what's going to happen, but I do know it's complex.
Thanks, Stephen. Mark, what are your thoughts? And, as Stephen says, Biden is aggressively pushing this through, but it's getting easier and easier to imagine a world in 2024 when Biden is not elected president again. So now, it's hard to see a Republican president deciding to push this forward.
Yeah. Procrastinate and play for time is probably the best defensive play here, and hope that the next administration in the USA doesn't have the same enthusiasm for it as the present administration. I don't see any particular reason myself, although I don't claim to be across all the technical detail, as why this couldn't happen or wouldn't happen. Yes, there are all sorts of complexities. What we count as profits in one area, how do you deal with different levels of capital allowance write-offs and all these sort of things? It's not just about the rates. Nevertheless, and I put this as a kind of open question because I don't know the historical details of it, the European Union, admittedly a rather more close-knit political entity than the OECD, managed to get a minimum level of sales tax, or VAT, agreed across all EU 28. And we don't have the same regime on sales taxes or value-added taxes right across the EU 28, as far as I'm aware. We do. Yeah. Everything is value-add.
You're allowed some different exemptions, but basically the system...
But we have exemptions on all sorts. We've got exemptions on newspapers, books. I don't know if that's universal across the EU. So my point is, despite the differences in the regimes, we have not an exemption, but a reduction for consumption of domestic fuel. That's at 5%. Is that universally true across the EU? I don't know. So they've managed to bring in a baseline. Is it 15% right across the EU? Even though there are these great differences in what we exempt from a sales tax or a value-added tax in the 28 jurisdictions. So in very broad, rough and ready terms, and accepting the huge differences between the institutional structures of the OECD and the EU, if the EU can do it on VAT, it doesn't seem obvious to me that the Americans and the OECD could not do it on corporation tax.
Well, governments are running out of money and desperate to get it, so I suppose they'll be putting all their resources behind figuring out how to do that. I'm going to take questions from the audience now. We have one in the front row, Alex. Put your hand up high, please. So we'll just take 3 questions first, second, and third row, and go from there.
Thank you. First of all, could I ask how the panel would like to see our taxation reformed? Secondly, as things stand, if we no longer had corporation tax, how would we finance the difference? And thirdly, I think, how would the team deal with the issue of some companies being able to clearly not pay a right rate of tax?
Great. Oh, thank you. Second row.
Cheers. Okay, thank you very much. Really great talk. I was wondering, given that this seems to be a cooperation between governments and governments being concerned with voting, how would the panel suggest that governments make the case to voters, or at least the panel make the case to voters, that a lower corporation tax that's differing from the global minimum would be beneficial for them? What sort of strategies would they use? How would they communicate it to ministers and to MPs and then on to voters?
Thank you. And there was a question in the third row, right on the end.
Yes, thank you very much to all the members of the panel. It's very good. I wanted to combine two factors you pointed out. Syed, on the one hand, used the word unfair. I think this is a very compelling argument. Whether we like it or not, it is perceived by governments, by voters, and by small businesses that a number of very headline-grabbing large companies, principally digital, principally US, had the access to the expertise to avoid paying tax at the levels that would have been seen as fair, and leading on from that in terms of a compelling counter-offer that might have some appeal mark. Whether it's the abolition of corporation tax, I don't know, but is there not a case for saying to those companies, you need to come forward with a much stronger contribution to this particular debate, otherwise justice, as people see it, will be done to you. Whether that's right or wrong, I don't know, but it will happen.
Thank you so much. So to round some of those questions up, how would our panel reform corporation tax? If you could balance your budget for me, please, and explain how you would make up the difference. That was the second one. To combine a few questions here, what do you do about companies that have this perceived sense of unfairness around them, and how do you make sure that the money is coming in? How do you make the case to voters for a lower corporation tax? Let's mix this up a bit and start with Saeed.
Oh.
No pressure.
No pressure. Thank you. Thank you very much. Howard, in terms of what we should be doing with taxation, I would just look at an unashamed advert for the IEA's publications on 20 taxes and simplification. I think there's been very well argued cases there. And it includes corporation tax, and it includes replacing corporation tax with some of the other taxes that Philip Booth has suggested. I mean, we all know this. Anyone who's an accountant knows, anyone who's actually tried to start a business. When I tried to start a business, I went to the Inland Revenue. They were putting on courses for so-called entrepreneurs. I deliberately booked 2 slots at different times and asked the same question and got different answers. And I went to a friend who was an accountant, and he said, they don't know what they're doing. This is why you need an accountant. And because we can argue the case. They genuinely don't know what they're doing. And I found that when I was self-employed, having all sorts of queries from the HMRC, and they just didn't understand it at all. So I would go for simplification. The problem is politically, people are always asking for exemptions. So, for example, I would, the Economist sometimes argues, and I'm sorry to say that word in this room, but the Economist sometimes argues for consumption taxes and tax consumption. The problem is that seems to be regressive. And also, if people will ask for exemptions. I mean, look at the whole debate over the so-called tampon tax, for example. If you started getting rid of all the exemptions for newspapers, etc., people say you're taxing children, you're taxing knowledge, all that sort of stuff. So it's really, really difficult politically. You just have to be brave and do it. And I'm not sure that anyone, even governments that have had big majorities, are brave enough to fundamentally reform the tax system. I also don't know internally, and this is my ignorance. No, sorry. That's the most unusual heckle I've ever had. I don't even know whether the Treasury has done this work about how you would simplify the whole thing. Maybe Liam can enlighten us whether there's been any thinking on simplification. I mean, I asked when we had a session with the Chancellor the other day, I asked him, have you thought about how we encourage more civil society local organisations at local levels, because at some stage the tax, if you look at the growth of the welfare state, it's grown out of control. The number of people paying in is relatively less compared to people taken out. Therefore, we have to look at alternatives. Otherwise, we're seen to not care about people. The moment you talk about cutting taxes, people assume that you don't care about the poor. That is the emotional argument. And Rishi, to his credit, said, we haven't been doing enough thinking on that. So I really think that, I don't know, and I may be unfair on the Treasury, but there has to be some thinking about tax simplification, making it easier, but then the politicians have to think about the political impact when we don't give exemptions. We get rid of as many exemptions as possible and simplify it, but that's really difficult politically.
Unfortunately, we've just implemented a new health and social care levy to come in a few years' time, so that will be even more complex. Mark.
Yeah, simplify the tax system. I've lost count of the page count now. Is it 14,000 pages long or something? Word count is 12 times the length of War and Peace. I mean, this is absolutely barking. It might be a rather blunt way of doing it, but I'd scrap the whole lot, rewrite it from scratch. Tell the people writing it that they've got to get the whole thing onto 14 sides of A4 and they have to use 28-point font and leave them to solve the problem from there. In terms of the exemption stuff, I think you've got to bite the bullet on that. You know, people might say it's taxing children or taxing knowledge. I'm not sure I'm against taxing children or taxing knowledge any more than anything else we might tax. But the big thing you could do, which would be popular and would add to simplification, is ending the extraordinary number of carve-outs for the affluent. Yeah. I mean, an absolutely extraordinary measure. 2 or 3 years ago, I came across this thing, I'd never heard of it, called VCTs. This is an absolute racket. You put your money into a VCT and you can write off 30% against tax. I'm putting in tens of thousands a year. It's a completely bizarre situation, but it's a way around the top rate of income tax.
It's great for small business, which is what we want.
But those are weird exemptions. I mean, I don't think that we should have some unbelievably complex. I mean, I started putting my money into it because of the taper on my pensions tax relief. I mean, you need a PhD in mathematics to work out what the most sensible way to invest your money is. And there are extraordinary carve-outs. I think, was it one of the carve-outs on investing in films, movies? You could invest in a lot of movies. And a good number of Premier League footballers realised if they therefore got their wife or girlfriend to wander around taking pictures with an iPhone and gave them 5 million quid, they could say, well, I've invested in the movie that my wife has made on this iPhone. It wasn't quite as straightforward as that, but not far off it. So ending the middle class carve-outs for the affluent, I think you could do, and alongside that, you could then cut the higher rates of tax. But I don't think we should have ISAs. I don't see why there should be a particular tax exemption for that. So rewrite it, simplify it. It would be the way forward. On the company stepping forward, Martin, I agree with you, and I haven't yet heard a compelling case against Philip Booth's proposition that you go after the dividends, and therefore, if you've managed to cheat in such a way that the share price goes up a lot, well, we'll catch you in the end, because suddenly your company is much more profitable at that end, and that's where we collect it. So as a simplification and a fairness, that strikes me as the right one. On the how do you make the argument to the electorate, particularly on this global minimum rate, depends which electorate you're speaking to. You know, I mean, I thought we'd left the European Union to take back control, not to have President Joe Biden setting our tax rates. That's a slightly strange roundabout way of going to it. But at a slightly less polemical level, I think we need solid empirical evidence on, which I mentioned earlier, where the instance of this falls, what its likely impact is on wages not going up or pensions not yielding a rate of return.
Thanks, Mark. Stephen.
Thank you. I don't know what the right level of tax is. It's above my pay grade. I do think measuring how much tax the country pays against their GDP is not a bad benchmark. And it's very interesting, actually, because when you look at Bermuda versus the US, the difference in percentage of GDP when Bermuda's claiming by others to be a tax haven is 1.5%. So the tax take in Bermuda is 1.5% less of GDP than in the States. Not many people realize that. And the way they do that is they have a big sales tax and they have a payroll tax. And you could argue, others do, that the good thing about sales tax is you only get taxed on what you spend. The bad part of that argument is there are significant social consequences, because the people at the bottom end of the food chain, in terms of earnings, are paying the same percentage tax, which they can ill afford, compared to the most wealthy person on the island. So The debate is a big one because it's not just quantum, it's actually manner of collection. And there's a huge variety around the world. The last thing I wanted to say on this one is that a corporation tax is a very volatile source of income to government, and it's very volatile to the corporation. It's particularly the case in, say, the oil industry, the pharmaceutical industry, the insurance industry, where by nature of what we do, we have volatile earnings. So from a governmental point of view, we're not a good source of revenue from them on a steady basis. If you're making widgets, that's a different thing, because the corporation tax is pretty steady every single year. So both for government and for corporations, corporation tax is not the best way of going forward, in my view.
Thanks, Stephen and Richard.
Thank you. Not much left to say, actually. Yes, the trouble is there's a difference between the answer that you'll get to these questions if you ask an economist or if you get a politician, because pretty much every economist would say, yes, abolish corporation tax. It's a disaster. It causes all sorts of unintended problems. Get rid of it, replace it with VAT. That's what we did in Jersey. It was very successful out there. But as Syed said, it's, I don't think he'd like to be trying to sell that to the electorate. So it's a political problem. Yes, VAT is regressive, but what you've got to do is look at the tax system as a whole, and if you've got one part of it that's regressive, you can counter that with income tax or something else that's progressive. So it needs to be looked at, as Stephen said, in the round to see what's actually going on. Philip's plan is great. Yes, it's very good. Taxing the dividends. Estonia did that. Basically, they had no corporation tax on the profits as they were earned, but then charged a tax on the dividends as they went out. Much simpler to do, certainly much harder to avoid, because the shareholders want their dividends at the end of the day, whereas you can manipulate profits, but you can't manipulate that cash flow of the dividends.
No, I'll split on that. What about share buybacks? How are they taxed?
Yeah. So the business.
If you sell the business, the profit's still in the business, so therefore at some point somebody's going to be taxed on the dividends when they come out. Share buybacks, I think, were taxed as dividends, but don't quote me on that one if you're planning any Estonian tax planning there. I'm no longer sure about simplification. I used to think tax simplification was a great thing, and I wrote lots of papers on it, and we said that yes, you get rid of all these exemptions and you use that to cut the rates. That's fine until the rates start going up and you've not got the exemptions anymore. And suddenly, which is what we're seeing in America, the drop in the American tax rate didn't actually reduce the tax payable by corporations, because what he did was increase them what they were taxed on. Yeah, so you're paying a lower rate on more profits. Basically, they stopped them being able to park profits out of the US tax-free. And then what we've seen in Biden is, yes, he's accepted the broadening of the tax base, but he's increased the rate back up again. So, yeah, it's a big problem. I'm starting to think that perhaps complex tax systems are the only protection for businesses against the government.
A tragic thought. We have a few minutes left, but I've been given the green light by our host to get one more round of questions. So please put your hand high in the air. I've got one in the front row here, and then a few in the back.
Andy from the IEA. In respect to winning the public battle, one area of international multinational organisations avoiding tax is the income tax that is not paid by the staff of organisations such as the UN, the EU and the OECD. Is a potential campaign counterblast to this to focus on that and what minimum tax level they will agree to pay in order to bring this in?
Excellent question. Second to last row.
Thanks very much. Yes, I wanted to talk about sovereignty. No one seems to get the implications for sovereignty on this. Yeah, we've just had the Brexit vote, which is all about sovereignty and self-government being number one. I, as an MEP, a former MEP, voted against the common consolidated corporate tax of the EU several times. In the ECJ, there have been several cases against Ireland and Belgium trying to force them to raise their tax. And it seems to me this is a Biden EU type deal going on. But I struggle. I've spoken to ex-chancellors, I've spoken to the ERG, I've spoken to Brexiteers. None seem to get this is a raid on sovereignty. And tax sovereignty is really very, very core to any sovereignty. So I just wondered why people aren't getting this. I mean, they don't want to upset Rishi because he's the star of the future, I'm sure, but you know, what else is going on? Thank you.
Thank you so much. Two excellent questions and an opportunity for our panelists to wrap up with their final thoughts. So that first one, maybe we need to get rid of some more exemptions for the UN, the OECD, the EU, and the tax that isn't paid through those institutions. And also, this is just fundamentally an issue of sovereignty. Should any country be asked to allow a bigger and broader institution to set their tax rate? Mark, let's start with you.
Well, I agree with you, David. I mean, the point I made, I find it extraordinary that you've got an administration which came into being because people were going to the wall on making sure that nobody in Brussels decided the curvature of a banana sold in the United Kingdom, but sort of swatting off down to Cornwall and allowing the President of the United States to set a corporation tax rate sort of is considered masterful geopolitics. I think it is extraordinary. I will just come back to there on that point that the arguments, I think there is a problem to be solved here. If you're going to retain corporation tax and you're going to say a lot of the profits are based on intellectual property, then there are mechanisms by which an individual country can completely game the system. You know, register your IP here at some ludicrous bargain buffet rate, or even, I'm not suggesting, I'm not going to point to anywhere this is happening, but you could imagine gaming the system by bribing the relevant authorities. You register your IP in that jurisdiction, you claim all of your profits are going to that IP, yeah. While in effect you're actually making that profit through your transactions in the rest of the world. So that is, if you want to keep corporation tax, that's a problem that you've got to solve. I don't want to keep corporation tax because I can't solve that problem. Agree with Andy on the exemptions in those areas. In fact, I've never actually worked out what on earth the justification is for them. These sort of, it's an elegant twist on diplomatic immunity for public servants, I guess, but there should definitely be considerably more finger pointing if we actually want to win the public over.
Richard?
Yeah, okay, thank you. Yeah, I love the idea of taxing OECD staff. It's particularly galling when they're complaining about businesses being undertaxed when their salaries are tax-free themselves. Sovereignty, yes, huge issue on this. The only reason I didn't talk about it was I expected Syed to talk about it with his MEP background, so I left that one to him. But yes, hugely important. There's a slightly bizarre twist that the way that they're doing it is if countries do persist in having lower tax rates, effectively they're then declaring that country's businesses almost outlaws and leaving them at the mercy of every other country in the world to tax them on the top-up basis. So it's a very odd way of going about it. Mark's point, yes, the UK used to understand these things, and we invented the intellectual property black box rules, which basically let you set up a intellectual property company, stuff all your IP into it, and just pay tax on it at 10%. And I'm not quite sure why they called it the black box, but I think it was just because no one was going to look at it too closely, and you were allowed to stash all your money away there. But the point was, the Treasury, the UK government, used to understand that you've got to be a bit flexible to attract businesses here and keep them here and allow them to expand. And suddenly, just when we need it, after Brexit, just when we need to be global and get all these innovative businesses going here and to attract capital from around the world, we seem to lose that ability to do what's right in the tax system to actually get them in here. It's going to be a huge problem. It's coming just at the wrong time. And I don't know what's happened to the Treasury and why they've suddenly reversed on this.
Stephen?
Well, I think two very good questions, and the answers have been given are good as well. I agree with your question. never understood it. Sovereignty, I think, is an issue that, as you're suggesting, I think, implying by your question, is being put under the brushed under the carpet. And I didn't say this directly, but I think that is maybe one of the unintended consequences. But those types of issues will come out, without doubt. It's a question of when, not if. And if they're not addressed on the way through, they will have to be addressed thereafter, and the thereafter will be much more painful, I would suggest.
And Saeed, last word to you.
Oh, thank you very much. I completely agree with your point, Andy, on employees of all these organisations having to pay they should pay tax. I'm not sure which ones are tax exempt and which ones just pay a different level of tax. So, for example, I know British employees of European institutions, EU institutions, when we were there, they paid community tax but didn't have to pay the UK tax. As David will know, there were 2 countries in the EU at the time that made their MEPs make up the difference in their tax return. That was the UK and Sweden. So we had to pay the same. I'm asking for a bit of sympathy there, and I'm clearly not going to get it. But I think it's right. I mean, I think we should point this out, and we should just carry on pointing this out, that the organisation and the employees of the organisation that are talking about this harmonised tax rate, and also arguing against transfer pricing, etc., should be themselves paying tax. Is it not hypocritical? And I think we should. I don't think we should be afraid of it. And I think maybe it's if any of you kind people with deep pockets would like to give the IEA some money to write that, I'm pretty sure we would write that. Not what you want, but what we don't obviously tackle it from a free market perspective. Secondly, on sovereignty. It's really difficult to make the argument about sovereignty now. I know it was one of the arguments for Brexit. People did make other arguments for Brexit, such whether it's fair immigration system, whether it's they were worried about the long-term impact of staying in the EU, all that sort of stuff. So it tends to get lost. The other thing is countries do delegate responsibilities to international governmental organisations. If you think about principal agent theory, where that all goes wrong, but they do delegate that, and therefore. In all sorts of other areas, countries have eroded their sovereignty or delegated certain tasks to international governmental organisations. It's very difficult then for this one particular issue to say, well, but we want sovereignty in this area. So I think that's where the waters get muddied when it comes to sovereignty. And you saw that in the referendum campaign, because we would say, oh, look at the EU, okay, you're talking about sovereignty, but what about NATO and Article 5, for example, or what about this other international organisation? So that becomes far more complicated in a world of liberal institutionalism, where individual countries have joined these international governmental organisations, delegated certain tasks, and accepted a certain erosion of sovereignty as a result.
Thank you, Saeed. I believe that our live stream is now coming to an end, so everybody here can breathe out. As a reminder, this discussion will be